Usually when we talk about like a medical diagnosis, there's this inherent expectation of precision.
Right, yeah. Like, it's a hard science.
Exactly. It's
Huh.
like engineering. You know,
Yeah.
you fall off a ladder, you break your arm, the x-ray shows that jagged white line on the film, and the doctor just points at it and says, there it is.
It's very binary.
Right. Broken or not broken. The data is entirely objective, and honestly, that's incredibly comforting. We really like our problems to be visible and easily categorized.
Oh, we completely crave that empirical certainty,
Yeah.
especially when the stakes are high. But, when you transition from the physical health of a human being to the financial and operational health of a multi-billion-dollar corporation,
Yeah.
that X-ray machine fundamentally changes. The contrast gets dialed way, way down.
Right. Suddenly we're looking at a diagnostic landscape that is entirely murky. I
Hmm.
mean, you're trying to x-ray human behavior and corporate culture and, financial incentives.
Which is incredibly messy.
So messy. And that is exactly what we are dissecting in this deep dive. If you are listening to this, I really want to set the stage for you. Today's session is, well, it's structured differently than our usual explorations.
We're taking a much more hands-on approach.
Exactly. We are treating this as a highly specialized VIP academic tutoring session designed entirely around building functional mental models. It's just you, me, and our resident expert here, and we have a very specific stack of source material to get through.
And I'm stepping into the role of the master tutor for the session. And I have to say, the material we are working with is notoriously rigid, but it's conceptually fascinating once you break it open.
It really is. We are looking at a stack of real-world Q&A scenarios pulled directly from the internal audit provisions of the Companies Act 2013 and the Standards on Internal Auditing.
Which we'll refer to as the SIA, just to save time.
Right, the SIA. Now, let's be honest. If you pick up this legislation and just try to read it cold, it is a wall of dense, highly technical corporate governance jargon.
Oh, it's brutal.
Yeah, it's the kind of regulatory language that seems almost designed to repel the average reader.
Well, that is the nature of regulatory frameworks, right? They are written to be legally watertight, not necessarily engaging. But mastering this material, whether you are, prepping for a masterclass level exam or you're an executive trying to understand your own company's governance, it isn't about rote memorization.
Right, memorizing clauses won't save you.
Exactly. Memorizing numbers and clauses will only get you so far before you just forget them under pressure. True mastery requires understanding the why behind corporate accountability.
Like, why did the regulators write it this way in the first place?
Yes. What corporate disaster or human behavioral flaw were they actively trying to prevent?
I love that. Because when you understand the underlying psychology and the friction of the corporate world, these rules stop being just dry text on a page.
They really do. They become a living, breathing system of checks and balances.
So our mission today is to take these dense scenarios and transform them into unforgettable knowledge. As your study buddy, I'm going to be pushing back, asking the obvious questions, and we're going to build sophisticated memory techniques and mental cheat sheets together.
I'm looking forward to it.
By the end of this deep dive, you will have a comprehensive mental map of how corporate auditing actually functions in the wild. Okay, let's unpack this.
Let's do it. And as we move through these cases, I want you to actively visualize the scenarios. Don't picture internal auditors as, stereotypical accountants sitting quietly in a windowless room with a calculator.
Right, no visors and adding machines.
Exactly. Picture them as corporate detectives. They are navigating immense political pressure, hunting down inefficiencies, and trying to protect the integrity of the organization.
Sometimes from its own leadership, right?
Quite often from his own leadership.
Which brings me to a question for you, the listener. Have you ever wondered who actually polices these massive corporations from the inside?
It's a great question.
I mean, we always hear about external regulators, but who is the first line of defense? And more importantly, how are those specific internal corporate detectives chosen? How do they get their badge?
That is the gateway to this entire framework. Before an internal auditor can even step foot in the building to do their job, we have to establish the legal foundation.
So, the ground rules.
Right. We need to answer two critical questions. When is a company legally forced by the government to hire an internal auditor? And who is legally permitted to sit in that highly sensitive chair?
Okay, let's tackle the who first. I'm looking at the first real-world scenario from our stack. This is Q1. It's the case of a professional named Partik.
Ah, yes, Pratik.
So Partik is a postgraduate in law. He has just finished a 25-year career in the Indian Audit and Accounts Service, which is a premier government service handling the auditing of massive public sector projects.
Right, a very distinguished career.
Yeah, so he takes voluntary retirement, he's looking to transition into the corporate sector, and he applies to be the chief internal auditor at a massive, publicly listed oil refining company.
A huge jump, but a logical one.
The board of directors interviews him. They are incredibly impressed with his government background, and they want to hire him.
It's a very common trajectory, actually. Moving from top-tier government oversight into private corporate oversight it's a lucrative path.
But wait, here is where my preconceived notions hit a brick wall. I always operated under the assumption that an auditor absolutely had to be a credentialed accountant,
That's what most people think.
like a chartered accountant, a CA, or perhaps a cost and management accountant. How on earth can a lawyer, even one with decades of government experience, get the chief internal auditor job at a leading oil refining company?
I get it. It feels wrong, right?
It really does. Doesn't the law require a specific, rigorous accounting degree to touch the financial controls?
Well, that is the instinctive reaction. But what is truly fascinating here is how the legislation actually prioritizes practical, demonstrable competence over a narrow set of academic titles.
Okay, color me intrigued.
If we look at the exact wording of Section 138 of the Companies Act 2013, it explicitly states that the internal auditor shall either be a chartered accountant, a cost accountant, or, and this is the fulcrum of the entire provision, such other professional as may be decided by the board.
Wait, such other professional?
Yep. That's the exact phrasing.
I have to say, that sounds like a massive loophole. If the board can just pick whoever they want, what's stopping them from hiring their, I don't know, their golf buddy who has a degree in art history?
Sounds like a loophole, sure.
Is it? Or is that a deliberate feature of the law?
It is entirely a deliberate feature, and honestly, it's a brilliant one. You have to remember, the law recognizes that a board of directors has the ultimate fiduciary duty to run the company properly.
They're the ones on the hook.
Exactly. They have the ultimate power and the ultimate liability to decide who possesses the right skills to conduct an internal audit of the specific functions of their specific company.
Okay, but still, an art history major.
Well, obviously the board has to justify the hire if things go south. Yes, CAs and CMAs are the gold standard for pure financial auditing, but internal auditing is no longer just about checking double-entry bookkeeping.
Right, it's vastly broader than that now.
Exactly. It encompasses governance, operational risk, legal compliance, supply chain efficiency, IT security, all of it. Now look back at Partik.
The lawyer.
Right. He's a postgraduate in law. That means he understands how to read complex contracts, regulatory statutes, and compliance mandates better than almost anyone.
Oh, that makes sense.
Furthermore, he has spent a quarter of a century in the Indian Audit and Accounts Service. The scale, complexity, and bureaucratic density of the government audits he has managed almost certainly dwarf the operational structure of this single oil company.
So the argument is that his specific blend of legal training and massive scale investigative experience is actually more relevant to auditing a complex oil refinery than a standard accounting degree would be.
Precisely. Experience and skill trump the specific letters after your name, provided the board formally signs off on it. The internal auditor's job is to hunt down risk.
Right.
If the board believes a seasoned legal mind with 25 years of government audit experience is the best hunter for the job, the law empowers them to make that hire.
Okay, so the who is much broader and more pragmatic than I realized. It's CAs, CMAs, or basically any professional the board explicitly trusts to get the job done. That definitely clears up the personnel side.
Good, so let's move to the other side of the equation.
Right, the when. Artik's target company is a listed oil refinery, so obviously they are under strict public scrutiny. But what about the rest of the corporate ecosystem?
This is where it gets a bit numerical.
When does a company cross the Rubicon? At what point does the government step in and say, you are now too big or too risky to just run your own shop without an internal auditor looking over your shoulder?
This brings us to the strict financial applicability thresholds outlined in the Companies Act. And because we are treating this as an academic tutoring session, this is where we need to build our first mental cheat sheet.
I am ready. I've got my mental notepad out.
The law basically divides the corporate world into three distinct categories, and the triggers for mandatory internal audits vary wildly depending on which category a company falls into.
Walk me through the categories.
Category one is the simplest, listed companies. If a company has offered its shares to the public and is listed on a recognized stock exchange, an internal audit is absolutely mandatory.
Always.
Always. There are no financial thresholds, no exceptions, no loopholes.
I guess because public money is directly at risk on the open market, the moment retail investors can buy your stock, the government demands maximum internal oversight. That makes perfect sense.
Precisely. Now, category two is where the complexity begins. Unlisted public companies.
Unlisted public, that feels like an oxymoron.
It kind of does, yeah. These are companies that are legally structured as public entities, meaning they can theoretically have an unlimited number of shareholders and fewer restrictions on transferring shares, but they haven't actually gone through an IPO and listed their shares on a public exchange.
Okay, got it.
For these companies, the law sets four specific financial triggers based on their performance in the preceding financial year. If they hit any single one of these four triggers, they must hire an internal auditor.
Okay, let's hear the triggers. And I should note for our global listeners, the source material uses the Indian numbering system of crores.
Right. Good point.
Just to contextualize the scale, 1 crore is 10 million rupees. So when we talk about 50 crore, we're looking at roughly 6 million US dollars, depending on exchange rates. It represents a very substantial mid-sized corporate footprint.
Absolutely. So what are the four triggers for an unlisted public company?
Let's hear them.
Trigger one, paid up share capital of 50 crore or more. Trigger two, turnover, meaning gross revenue or sales of 200 crore or more.
Okay, 50 for capital, 200 for turnover.
Trigger three, outstanding loans or borrowings from banks or public financial institutions exceeding 100 crore or more at any point of time.
At any point of time. Got it.
And trigger four, outstanding deposits of 25 crore or more at any point of time.
Okay, paid up capital at 50, turnover at 200, loans at 100, deposits at 25. That's a lot of disparate data points to memorize.
It's a mouthful.
Yeah, and if I'm sitting in an exam or sitting in a boardroom trying to quickly assess a subsidiary, I'm going to jumble those numbers. We need a memory technique.
We absolutely do. Let's use a mnemonic to lock this in. Let's look at the initials of those metrics. Paid up, turnover, loans, deposits, PTLD.
PTLD. Okay.
For unlisted public companies, I want you to remember this phrase. Publix put tomatoes, lettuce, and dressing.
Publix put tomatoes, lettuce, and dressing. Okay, I like a good sandwich analogy.
Right. So Publix put is the paid up capital. That threshold is 50. Tomatoes is turnover. That's the biggest number, 200.
The thick slice of tomato.
200. Exactly. Lettuce is loans. That threshold is 100. And dressing is deposits. That's the smallest garnish at 25.
Okay, PTLD Publix put tomatoes, lettuce, and dressing. 50, 200, 125. So an unlisted public company have to monitor the whole sandwich. If any of those four ingredients cross their respective number, an auditor is mandatory.
You've got it perfectly. Now let's look at category three, private companies.
How does the sandwich change for them?
Well, private companies are inherently smaller, the shares are restricted, and they don't take money directly from the general public in the same way. Because their public footprint is smaller, the regulatory burden is lighter.
Makes sense.
So the law drops the first and the last metrics from our mnemonic. Private companies only get the middle ingredients.
Oh, so privates just get tomatoes and lettuce.
Exactly. Privates just get tomatoes and lettuce. T&L.
Okay, so for a private company, the government doesn't care about the paid-up share capital, and they don't care about deposits. They only care about turnover and loans.
Precisely. For a private company, the triggers are only turnover of 200 crore or more, or outstanding loans exceeding 100 crore. T&L.
Tomatoes at 200, lettuce at 100. If you can remember, Publix put tomatoes, lettuce, and dressing, and privates just get tomatoes and lettuce, you literally have the entire legal applicability framework memorized.
It's a bulletproof mental model.
Okay, let's immediately stress test this model with a real-world trap from our sources. This is Q7, the case of WWF Ltd.
Oh, this is a beautifully constructed trap. It catches out executives and students alike all the time.
Let's lay it out. WWF Ltd is an unlisted public company, so they have the full PTLD sandwich to worry about.
Correct. All four ingredients.
They had a paid-up capital of 40 lakhs, which went up to 60 lakhs. Turnover in the last 3 years was 49 crores, 145 crores, and 150 crores.
Okay, so let's pause there.
All right, so paid-up capital is basically nothing compared to the 50 crore threshold. And turnover maxed out at 150 crore, which is under the 200 crore tomato limit.
Exactly. So far, they're safe.
But here is the critical detail. During the previous financial year, they needed capital, so they took out a massive loan from a public financial institution for 110 crores. However, they had a good quarter, and being responsible corporate citizens, they repaid 20 crores of that loan before the financial year ended.
Very responsible of them.
So on the official year-end balance sheet, the outstanding loan sits exactly at 90 crores. Management looks at that balance sheet and says, look, the lettuce threshold for loans is 100. We're at 90. Therefore, no internal audit is mandatory.
And this is where they fall right into the trap.
Are they right? I mean, from a pure snapshot perspective, on December 31st, they are under the limit.
This is where we have to ask why the law is written the way it is. Why does the government care about the loan amount in the first place?
To protect the banks.
Exactly. They care because a massive loan means a public bank has taken on massive risk. If this company collapses, the bank suffers, and by extension, the entire financial system suffers.
Right.
So the law specifically states that the outstanding loan must exceed 100 crore rupees at any point of time during the preceding financial year.
At any point of time. That phrase is the entire trap.
It is the ultimate tripwire. Management is conveniently pointing to the neat, tidy year-end balance of 90 crores. But on, say, a random Tuesday in October, they borrowed 110 crores.
At that precise moment, they crossed the 100 crore threshold. The tripwire was activated?
The fact that they later paid it down is completely irrelevant to the applicability of the audit requirement. The bank was exposed to 110 crores of risk during that year.
Wow.
The government demands that an internal auditor be brought in to evaluate the controls around how that massive influx of cash was handled when it was in the building. Once you cross the line, even for a single day, you're legally on the hook to have an internal auditor for the following year.
So management's contention is just a complete misinterpretation of the statute. They hit 110, the tripwire snapped, they must hire an auditor.
Correct.
Let's do a rapid-fire evaluation to really lock this in. This is from Q11, a scenario involving group companies. An independent director is staring at 3 different companies in their portfolio and wants to know which ones need an internal auditor.
Let's run them through the model.
Let's screen one. XYX Limited. It is a listed company.
That is the easiest one. Listed means Category 1. Public money is on the stock exchange, and internal audit is always mandatory. No thresholds need to be checked.
Okay, company 2. M&M Limited. It's an unlisted public company. It has 60 crore in equity share capital.
Okay, unlisted public means they have the full PTLD, tomatoes, lettuce, and dressing rule. The P is paid-up capital, which includes equity share capital.
The threshold for P is 50.
Right. And M&M has 60 crore. 60 is greater than 50. The tripwire is snapped. Yes, M&M must hire an internal auditor.
Okay, company 3. GFG Limited. It's an unlisted private company. It has 70 crore in equity share capital, 180 crore in turnover, and an 80 crore outstanding loan from a bank.
Let's apply the private model. It is a private company. Therefore, privates just get tomatoes and lettuce. We only look at turnover and loans.
Right, T&L.
The turnover threshold is 200 crore. They only have 180. They are safe.
And the loan threshold is 100. They only have 80. They're safe.
Exactly. Now, what about the 70 crore in equity capital? It's above the 50 mark. But remember, the P does not apply to private companies.
Right. Paid-up capital cannot trigger an audit for a private entity.
Therefore, GFT Limited completely misses all relevant triggers. No internal auditor is legally required.
Wow. By categorizing the company first and then applying our tomato and lettuce mnemonics, we completely bypass the cognitive overload of all those intersecting numbers.
It makes it so much cleaner.
We know exactly who gets hired and exactly when they must be hired. But now we are transitioning into the reality of the job itself. We enter section 2 of our deep dive, the blueprint.
This is where it gets highly operational.
Let's imagine the tripwire has been snapped. The company is forced to hire someone. What happens on day 1? How does this newly hired internal auditor structure their mission without getting immediately compromised by the intense corporate politics of the executives they are supposed to be watching?
This is where the pristine theory of auditing violently collides with the messy reality of human dynamics and corporate power structures.
I can only imagine.
Because an auditor who is controlled by the very people they are mandated to audit is worse than useless. They provide a highly dangerous illusion of security.
Let's look at the case of XYZ Ltd. to illustrate this. They are in the process of appointing Mr. A as their new chief internal auditor. The managing director, essentially the CEO, has casually instructed the HR head to define the reporting structure for the new hire.
A seemingly innocent request?
Right, but the HR head is now sitting at their desk trying to figure out where to draw the lines on the organizational chart so that Mr. A can actually discharge his duties objectively.
The HR head has a monumental and delicate balancing act here. The internal auditor is an employee. They need a physical desk, they need to be enrolled in payroll, they need their travel expenses reimbursed.
They need their vacation time approved.
Exactly. But simultaneously, their core job description might require them to investigate the travel expenses of the CEO who signs that vacation request.
I was pondering this dynamic, and I keep coming back to the concept of an undercover agent deep inside a syndicate.
Oh, I like that.
You know, to survive day to day, you need a highly convincing cover identity. You have to blend into the machinery, report to a boss, and do the daily grind. But your true, unyielding allegiance is to the agency back at headquarters. You live a formalized dual life.
That is an exceptionally accurate analogy. In the realm of corporate governance, that dual life isn't hidden. It is legally formalized. It is known as the dual reporting structure, and it is the absolute bedrock of auditor independence.
How does it work practically?
Well, administratively, the chief internal auditor must report to the CEO or the managing director. This handles the cover identity aspects you mentioned: payroll, HR benefits, departmental budgeting, and routine performance reviews for the audit staff.
But functionally, where does their true allegiance lie?
Functionally, they must report directly to the audit committee, or in its absence, directly to the board of directors. This is utterly non-negotiable if you want true independence.
Why is it non-negotiable?
The very definition of internal audit emphasizes providing independent assurance. Imagine if the auditor uncovers a scheme where the CEO is funneling company funds to a shell corporation. If the CEO is the only person the auditor reports to, what happens?
The CEO reads the draft report, fires the auditor on the spot, shreds the report, and the fraud continues.
Exactly. The functional reporting line to the audit committee acts as a protective bypass valve. It guarantees the auditor has a direct, unobstructed line of communication to the highest governing authority in the company, the people representing the shareholders.
So it's a safety net.
It ensures the auditor can speak absolute truth to power without the paralyzing fear of administrative retaliation. They can report the CEO's malfeasance, knowing the CEO does not have the authority to terminate their employment for doing their job.
It protects the integrity of the entire function. And it ensures they are independent, not just in their own mind, but in appearance.
Appearance is crucial.
Right, if the rank-and-file employees know the auditor reports solely to the CEO, nobody will blow the whistle to the auditor. The dual reporting structure signals to the whole company that the auditor is truly an independent watchdog.
Very well said.
Okay, so our undercover agent is securely in place. The organizational chart is drawn correctly. Now they have to actually execute a mission. Let's look at Q8.
Let's see what Q8 has in store.
The audit committee at Zero Ltd. has summoned their new auditor, Mr. Shoup. They have a specific mission for him: perform a detailed forensic analysis of the company's operating expenses and find the underlying gaps and leakages.
A classic broad mandate.
He's sitting at his desk on Monday morning. How does he actually begin? What is the blueprint? He can't just walk down to accounting and start pulling random receipts out of a filing cabinet, right?
If he does that, he will drown in data and find nothing. Random sampling without a strategy is just chaos. The standards on internal auditing mandate a rigid, sequential, 5-step process that every single audit engagement must follow.
It's time to build our next mental model. For our listeners aiming for mastery, how do we memorize the sequential anatomy of an audit?
Let's use another mnemonic. This one is very visual. Think of kangaroos play games catching rings.
Kangaroos play games catching rings. Okay, I'm picturing a very athletic kangaroo at a carnival.
Exactly. The letters are K, P, G, C, R. This is the intelligence cycle of auditing. Let's break it down. Step 1 is the K. Obtain knowledge of the business and its environment.
Because you cannot audit a machine if you don't know what the machine is supposed to build.
Precisely. If Mr. Shoup is auditing an airline, he needs to understand fuel hedging, regulatory aviation constraints, and seasonal ticketing variations. If he doesn't understand the environment, he won't recognize an anomaly when he sees one.
Okay, so K is knowledge. What's next?
Step 2 is the P in play, audit planning.
Once you have the knowledge, you draw the map.
Yes, you define the scope. Are we looking at the last 12 months or 3 years? Who are the key executives we need to interview? What are the high-risk expense categories? This is where the strategy is crystallized.
We got K, P, then G.
Step 3 is the G in games. Gather required information.
The actual fieldwork.
This is the excavation phase. Downloading the massive ledger files, pulling the physical contracts, conducting the interviews, extracting the raw data from the IT systems.
Okay, kangaroos play games. Catching. C.
Step 4 is the C. Perform audit checks.
This is where the actual auditing happens, right? The stress test.
Exactly. You have gathered the data, now you interrogate it. You compare the actual expenses against the approved budget, you verify the mathematical accuracy, you look for duplicate payments, you test whether the internal controls actually prevented unauthorized spending.
And finally, rings the R.
Step 5 is the R reporting of internal audit issues.
Taking all the raw data from the checks and synthesizing it into actionable intelligence for the audit committee. KPGCR: knowledge, planning, gather, checks, reporting.
It is a highly logical cascade. If you follow the kangaroo, you won't miss a step.
I really love that.
Mm-hmm.
But I want to zoom in on step 2 for a moment, the planning phase. In Q6, we have a scenario where Mr. Gopal isn't just planning a single audit. He has to present his internal audit plan for the entire organization for the whole year.
Ah, the annual plan. That is a completely different beast.
It seems like an impossible task. A modern corporation has thousands of processes. He has finite staff and finite time. How does he decide what gets put on the plan and what gets ignored?
You have just identified the eternal existential struggle of the chief internal auditor. Finite resources attempting to cover infinite risks.
Right. How do you prioritize?
If the planning phase is flawed, the entire year is wasted, auditing things that don't matter. When Mr. Gopal creates this annual plan, the SIA mandates that he must carefully balance 5 distinct competing elements.
Let's build a model for this. What's the formula for prioritizing chaos?
Let's use the mnemonic. Real vampires eat all carrots.
Wait, real vampires eat all carrots?
Yep. RVEAC. It represents the 5 elements that must be balanced in an audit plan.
Okay, I am definitely going to remember vegetarian vampires. Let's break it down. R is for?
The R stands for risk, the risk underlying the business process.
This is obvious triage. I mean, a process that handles hundreds of millions of dollars in international wire transfers inherently carries a higher risk of catastrophic loss than the process for ordering break room coffee. You allocate resources toward the fire.
Yes, risk is always the primary driver. Then we move to the V, a value provided to the organization.
Give me an example of low value versus high value.
Suppose the company has a department that is already heavily scrutinized by external government regulators who audit them quarterly. If the internal auditor goes in, they are likely just duplicating work and annoying the staff. That's low value.
Oh, right.
But what if the company just launched a brand new experimental AI-driven customer service platform that has never been tested? An internal audit there provides massive unprecedented value by identifying blind spots.
Okay, so risk and value.
Right.
Real vampires eat the E.
The E stands for effort, the effort involved in conducting the audit.
The return on investment for the auditor's time.
Exactly. If an audit will require flying 5 people to a remote warehouse for a month, but it only addresses a mathematically insignificant operational risk, the effort-to-reward ratio is fundamentally broken. You don't spend $50,000 of payroll to find a $5,000 inefficiency.
That makes total sense. Okay, real vampires eat all. The A.
The A stands for appetite, the risk appetite of the organization. This is a highly nuanced concept.
How so? Isn't risk just risk?
Not at all. Risk appetite varies wildly based on corporate culture. A 3-year-old aggressive tech startup might have a massive risk appetite. They're willing to break things and accept high operational risk in exchange for hypergrowth.
Move fast and break things.
Exactly. But a 100-year-old conservative commercial bank has a near-zero risk appetite. They value stability above all else. The internal audit plan must be calibrated to align with what the board of directors considers an acceptable level of risk.
So the auditor shouldn't spend 6 months trying to eliminate a minor risk that the board is perfectly happy to accept.
Precisely. And finally, the C in carrots stands for coverage.
Meaning, you can't just audit the finance department every single year because it's easy and completely ignore the IT security department for a decade. Over a multi-year cycle, everything must eventually be touched by the auditor.
Exactly. You must ensure broad systemic coverage over time. RVEAC. Real vampires eat all carrots. Risk, value, effort, appetite, coverage.
If Mr. Gopal aggressively filters every potential audit through that matrix, he will present a bulletproof, highly optimized plan to the audit committee.
What's fascinating here is how these models work together.
What's fascinating to me is that at first glance, all these acronyms and five-step processes seem incredibly bureaucratic.
Uh,
But if I'm understanding you correctly, these rigid frameworks actually grant the auditor immense freedom.
how do you mean?
Well, it's a paradox. When you have a rock-solid structural foundation, when your brain automatically processes the KPGCR kangaroo steps, and you automatically balance your priorities using the vegetarian vampire matrix, you don't have to waste precious mental energy worrying about the logistics of the audit.
Oh, I see where you're going with this.
You don't wake up in a cold sweat wondering if you missed a step. The framework handles the scaffolding. That frees up your cognitive capacity to do the real work. Looking closely at the data, noticing the strange psychological anomalies and how a manager answers a question, allowing yourself to be fiercely curious.
The structure isn't a cage.
Right, it's the foundation that allows you to safely explore the dangerous edges of the company.
That is a profound insight, and it is entirely accurate. The structure guarantees that no stone is left unturned, which allows the auditor's intellect to focus entirely on what is hiding under the stone.
But speaking of cages and boundaries, we need to transition into Section 3 of our exploration.
The red lines.
Exactly. We spent all this time establishing what the auditor must do, how they plan, and who they report to. But power and access can be incredibly dangerous. To maintain that pristine objectivity we discussed, there are incredibly strict boundaries that an internal auditor can never, ever cross.
We are shifting from the proactive mandate to the absolute prohibitions.
Let's dive into Q2 to see this in action. CA David is the internal auditor for a listed company. Now, this company operates in a highly scrutinized sector, and they are terrified of the market regulator. Let's say it's the SEC or SEBI.
They want to be flawless.
Right. They want their compliance to be absolute perfection. So the management team approaches Diva with what sounds like a promotion. They say, Diva, you are a leading expert on compliance frameworks. We want you to personally design and manage our day-to-day compliance tracking system.
Oh, boy.
And while you're at it, since you know the law so well, we want you to be the primary person who directly corresponds with the government regulators on our behalf.
This is a classic scenario.
Now, on the surface, his job description mentions ensuring compliance with laws and regulations. So can he say yes? It sounds like a massive compliment to his competence.
It is a compliment that, if accepted, will systematically destroy his career, his professional integrity, and the company's entire governance structure.
Wow. Okay.
This is a massive, fatal conflict of interest. I call it the compliance trap.
Break down the trap for me. Why is it fatal?
Because of the fundamental law of auditing. You cannot objectively evaluate a system that you built and maintain. If Diva accepts this role, he ceases to be an auditor and becomes a part of the executive management team. Ah, I see.
Think about the psychology of self-preservation. If Diva designs the compliance tracking system, and 6 months later he is performing an internal audit and realizes his system has a massive, embarrassing flaw that resulted in a regulatory breach,
Is he going to write a scathing internal audit report to the audit committee highlighting his own incompetence?
Exactly. Of course not. Human nature absolutely forbids it.
Yeah.
He would instinctively try to patch it quietly or minimize the damage in the report. He loses his objectivity entirely.
It is the classic you cannot grade your own homework scenario.
Precisely. The internal auditor exists to provide the board with independent assurance that the executive management is doing their job properly. The moment the auditor starts doing management's job, that independent assurance vanishes into thin air.
Because he is responsible for auditing the compliance framework, but management fundamentally owns the execution of that framework. If he starts corresponding with regulators, he is acting as an executive officer. That distinction is so clear when you frame it around human psychology.
Yeah.
And we see this exact same rigid boundary applied to the pure numbers in Q12A.
Let's look at Q12A. Rishi is the internal auditor for SPO Unlimited. He is doing his KPGCR checks, and he notices significant mathematical discrepancies in the disbursement records.
Okay.
He also realizes the company has implemented new business policies without documenting them properly. Now, Rishi's an expert. He knows exactly how to fix the math in the accounting software, but he cannot jump into the system and start making journal entries to fix the ledgers, right?
Absolutely not. That is the accounting trap. Rishi is strictly forbidden from performing executive accounting functions. He must operate entirely independent of the accounting staff.
Because if he fixes the ledger, he becomes the author of the financial statements.
Exactly. He becomes part of the financial record creation process.
Right.
If he authors the ledger, who is going to audit his work?
Yeah.
The internal auditor is the mirror reflecting reality back to the board. He is not the surgeon allowed to cut into the patient. His mandate is to observe the facts, appraise the flawed policies, document the numerical discrepancies, and forcefully bring those deficiencies to the attention of the authorities who actually have the operational mandate to fix them.
So he observes, he appraises, he reports, but he never, ever touches the actual ledgers.
Never.
Okay, here is where this dynamic gets incredibly interesting. We know the internal auditor must stay away from executive management's job, but what about the relationship between the internal auditor and the external statutory auditor?
Ah, yes. The internal-external dynamic.
The external auditor is the one who signs the final public-facing audit report that goes to the shareholders and the stock market.
It is a relationship that is meant to be synergistic, but it is fraught with tension and strict regulatory firewalls.
Let's look at the case of Up-Down Limited to explore this. This is covered in Q3 and Q12B. Up-Down Limited is in serious trouble. Demand for their products has plummeted for 2 consecutive years.
A very stressful environment.
Extremely. The external statutory auditor, let's call him C.A. Neaton, is deeply worried about the going concern assumption.
For our listeners, the going concern assumption is essentially the ultimate question. Is this company actually going to survive the next 12 months, or are they on the verge of bankruptcy?
Right. Now, the internal auditor for Up-Down Limited has already done a massive amount of work on this exact crisis. They helped management devise a turnaround strategy, they evaluated new product lines, and they spent weeks preparing incredibly detailed estimates of future revenue and cash flows.
They've done the heavy lifting.
Exactly. So C.A. Neaton, the external auditor, looks at this mountain of work and says, this is fantastic. The internal auditor is an expert and already did the complex math. I am just going to rely entirely on his cash flow estimates to sign off on the going concern status.
Or better yet, he'll ask the internal auditor to directly assist him in evaluating it.
Right. From a purely operational standpoint, isn't that just efficient teamwork? Why should Nitin reinvent the wheel and build a company for hundreds of hours of redundant work if the internal expert already did all the math?
It sounds incredibly efficient on paper, but it violently violates a core non-negotiable tenet of external auditing. This scenario brings us directly to standard on auditing SA 610, which governs using the work of internal auditors.
SA 610, the firewall between internal and external. Why does this firewall exist?
It exists because the stakes are existential. The external auditor, C.A. Nitin, bears the sole, undivided legal and professional responsibility for the final audit opinion expressed to the public markets.
He's the one signing his name.
If he signs a report saying the company is fine and they go bankrupt 3 weeks later, the shareholders will sue him into oblivion. He cannot outsource that ultimate responsibility.
Makes sense.
Therefore, SA 610 dictates that for what the standards define as significant judgments, the external auditor must perform direct, independent procedures themselves. They are legally barred from simply copying the internal auditor's homework.
So what exactly qualifies as a significant judgment?
Assessing the overarching risks of material misstatement, evaluating complex, subjective accounting estimates, and most crucially for Up-Down Limited, evaluating the appropriateness of management's use of the going concern assumption.
Because deciding whether a company is going to live or die is the most significant judgment an auditor can make.
Exactly.
But again, if the internal auditor is highly competent, why can't Nitin trust him? They're both professionals.
Because of the subtle, inescapable reality of inherent bias. Think about the risk profile. The internal auditor, while functionally independent of executive management, is still an employee or a dedicated contractor whose livelihood is tied to the survival of Up-Down Limited.
Oh, I see.
They sit in the same building, they know the people, they want the turnaround strategy to succeed. They might possess an inherent, completely subconscious bias towards believing the optimistic cash flow projections.
Oh, man.
The external auditor exists to provide the ultimate, unvarnished, emotionally detached reality check to the public markets. If the external auditor relies solely on the internal auditor's potentially optimistic estimates, that independent external safety net is entirely destroyed.
We've seen variations of this failure in massive corporate collapses, haven't we? Where external auditors got too comfortable with internal management narratives.
We absolutely have.
That makes profound sense. The external auditor is the final circuit breaker. So under SA 610, C.A. Neaton cannot ask for direct assistance regarding the going concern assumption, and he certainly cannot just blindly accept the internal cash flow estimates.
He has to sit down, do his own math, run his own brutal stress tests, and make his own objective judgment, regardless of how much time it takes.
So teamwork is acceptable for gathering basic objective evidence like verifying inventory counts, but the ultimate judgment can never be delegated.
Precisely summarized.
Okay, we have thoroughly established the boundaries. We know what the auditor must never do. They don't grade their own homework, they don't surgically alter the ledgers, and they don't make significant judgments on behalf of the external auditor.
Which brings us to the fun part.
Yes. I want to step into Section 4, the hunt. We are shifting out of the theoretical framework and into the field. What actually happens when the internal auditor goes on the prowl within their legally permitted territory?
This is where the profession becomes less about reading rule books and much more about acute, cynical observation. Let's examine the fascinating and highly illustrative case of Dreams PVT Ltd.
Okay, this is Q15 in our stack. Paint the picture of the environment for us.
Dreams PVT Ltd. is a mid-sized travel management company. They specialize in highly customized domestic and international corporate tours. Now, factor in the macroeconomic environment. During the COVID-19 pandemic and the immediate aftermath, they suffered catastrophic revenue losses.
Right, the entire global travel industry essentially evaporated overnight.
Consequently, the company went into a severe, desperate, cost-cutting regime just to keep the lights on.
Total survival mode. Every single penny leaving the building is being scrutinized.
Exactly. In the midst of this, they appoint an internal auditor to help them find further inefficiencies. The auditor begins their kangaroos play games process. They go on the hunt, and they document 3 incredible observations.
Let's hear them.
First, while walking the physical premises, the auditor finds a massive, fully equipped hall being rented by the company to serve as a gym facility for employees.
A gym?
Yes. But upon checking the keycard access logs, the auditor realizes this huge, expensive gym is only being utilized, on average, 1 to 2 days a week by a handful of staff.
Paying premium commercial rent for an empty gym during a corporate financial crisis.
Yeah.
That is a massive red flag.
Second, the auditor reviews the treasury management and finds a massive pile of uninvested cash just sitting idle in a basic corporate checking account,
Just sitting there.
earning 0 interest. When questioned, the management claims they couldn't decide how to invest it safely because of fluctuating market situations, so they essentially paralyzed themselves and just left it there.
Leaving millions in cash under a metaphorical mattress while inflation silently eats away its purchasing power. Unbelievable.
And third, the auditor reviews the IT logs and notices that every single day there is a 1-hour downtime during peak working hours where the core booking computers and servers are completely offline for maintenance.
Okay, so the auditor has found the empty gym, the lazy cash, and the dead operational hour. They document these findings and prepare to put them in the draft report.
But then Mr. X enters the chat.
Right. Mr. X, a senior manager at the company, intercepts this and pushes back aggressively. He tells the auditor to back off and delete those findings.
He was not happy.
His exact documented argument is that matters regarding resources utilization are not related to internal audit and therefore should not be commented upon.
He is essentially telling the auditor, your job is to make sure the math is right, not to tell us how to run the business.
This argument is unbelievable. It's exactly like hiring a highly paid personal trainer to help you get in shape. The trainer walks in and notices that instead of lifting weights, you are sleeping on the gym mats.
Huh. Yes.
And when the trainer wakes you up to complain, you point a finger at them and say, hey, back off. You're only paid to count my reps. You're not legally allowed to comment on how I utilize my time in the gym. It is an absurd defense mechanism.
Your analogy highlights the exact psychological defensiveness that auditors face daily, and it perfectly illustrates why Mr. X's argument is fundamentally legally flawed.
How does the auditor dismantle it?
As an academic tutor, if a student presented Mr. X's defense to me, I would triumphantly point them back to the core regulatory mandate outlined in Q4 of our materials. Evaluating the utilization of resources is not just a nice-to-have optional extra for an overly ambitious auditor.
It's mandatory.
It is a core mandated pillar of an internal auditor's legal job description. The auditor simply refers directly to the codified scope of internal audit. The auditor is legally required to check whether proper operating standards exist for the economical and efficient use of resources.
So let's break down the findings through that lens.
An empty commercial gym rented during a desperate cost-cutting phase is the very textbook definition of an underutilized physical resource.
Right.
A massive pile of cash, losing potential interest revenue because of management indecision, is a massive failure of financial resource optimization.
And the computers.
A daily 1-hour tech blackout for a travel agency whose entire business relies on live booking systems is a critical inefficiency of technological resources.
So the auditor isn't just counting the money to make sure it hasn't been stolen. They are actively evaluating if the money is actually working hard for the company.
Exactly. The auditor has an affirmative duty to highlight these specific weaknesses and provide actionable suggestions for improvement. They must calculate and point out the exact mathematical loss of interest on that idle cash.
They have to question the return on investment of the gym lease.
Yes. Mr. X's opinion is legally, functionally, and practically completely untenable. The auditor must report these findings to the audit committee, regardless of how embarrassed Mr. X is.
That perfectly illustrates a physical and operational hunt. Finding the empty room, the idle bank account, the dead server. But as we know, the corporate hunt is increasingly moving into purely digital landscapes.
Oh, absolutely.
Let's look at Q14, the case of High Limited, where we're moving from physical gyms to digital fingerprints.
And the digital landscape is where modern auditing truly lives or dies. The complexities are staggering. High Limited is deeply concerned with complying with Rule 11 of the company's rules, which specifically mandates maintenance of audit trails in their accounting software.
Also known as edit logs. Let's clarify this for the listener. Rule 11, the audit trail. This is basically the underlying software code that tracks every single time a human being touches the financial data, right?
Yes. It is a continuous, immutable record. It tracks exactly who logged in, what specific journal entry they created or altered, and the exact timestamp of when they did it.
It is the digital fingerprint of every single financial move a company makes.
Now, the management of High Limited approaches their internal auditor, CAJ, and asks for a blueprint. They need a list of specific internal IT controls they need to implement to prove to the external auditors and the government that their audit trail is actually functional.
And that it hasn't been tampered with by a malicious insider.
Right. So CAJ needs to outline 5 highly specific interrelated IT controls.
So what does CAJ tell them? How do you build a fortress around a digital fingerprint?
First, and perhaps most obviously, they must implement strict controls to ensure the audit trail feature hasn't been disabled or deactivated at the software level.
Right. It's like installing a state-of-the-art security camera system. Step 1. Make sure nobody unplugs the camera. If the logging is turned off, you're flying blind.
Precisely. Second, they need controls to ensure that unique user IDs are permanently assigned to each individual employee.
Okay, unique IDs.
And that the system strictly prohibits the sharing of these IDs or passwords.
Why is this one emphasized so heavily? In a lot of fast-paced operations, if my team all knows the same generic admin password, it's just easier to log in and get the work done.
Because the entire concept of an audit trail relies on accountability, and accountability requires absolute specificity. Imagine there is a fraudulent entry that shifts $1 million to a vendor. The auditor looks at the log and it says the user finance admin made the change. But if 5 different people in the department shared that exact login, you have no idea who actually committed the fraud.
The digital fingerprint is completely smudged. You have 5 suspects and no proof.
Unique IDs enforce a concept called non-repudiation. If your unique ID made the change, you cannot deny that you made the change.
Got it. Unique IDs enforce personal accountability. What is the third control in the fortress?
Third, controls to ensure that any changes to the configurations of the audit trail itself are strictly authorized and immutably logged.
Wait, you have to audit the audit trail.
Exactly. This addresses the ultimate insider threat, the superuser.
Who audits the watchers?
Exactly. Imagine an IT administrator who has the highest level of system access. If that superuser goes into the settings and changes the configuration so that transactions under $5,000 are no longer logged by the audit trail,
That creates a massive invisible vulnerability for fraud.
therefore, the system must create a log every time someone changes the rules of the logging system.
That is deeply meta, but I see exactly why it is the most critical vulnerability. Okay, what is the fourth control?
Fourth, Strict access controls. Access to view, and especially to alter, the audit trail logs and backups must be severely restricted to a tiny handful of authorized personnel.
And furthermore, you need a system that logs who access the logs.
It really is turtles all the way down. But seriously, if an executive commits embezzlement, their first move is going to be trying to access the log file and simply hit the delete key to erase the record of their crime.
You have to put a vault door on the logs themselves.
Precisely. And finally, the fifth control. Periodic backups. Management must ensure that encrypted backups of all audit trails are taken regularly, daily, or hourly.
And archived safely on separate secure servers.
For the entire statutory period required by law. This ensures that if the primary accounting system suffers a catastrophic hardware failure, a ransomware attack, or is intentionally destroyed to hide a crime, the digital fingerprints survive off-site.
Let's review the digital fortress. No disabling the feature, strictly unique IDs, logging any configuration changes, restricting physical and digital access to the logs, and backing everything up securely.
If management implements those 5 controls, their digital audit trail is legally defensible. It has to be airtight. In a modern, highly digitized corporate world, physical paper is disappearing. The electronic edit log is often the only objective truth an auditor has left to rely on.
We have covered incredible ground. The hunt is over. Our internal auditor has executed the KPGCR process. They have found the empty gem, the idle cache, the dead servers, and they have rigorously verified the digital fortresses.
They are sitting at their desk with a mountain of critical findings.
But here is the reality of corporate life. An unread finding is a useless finding. A brilliant piece of analysis that sits in a PDF on a server does nothing to protect the company.
Absolutely nothing.
We are now entering Section 5 of our deep dive, the aftermath. How does this auditor take this critical information and format it in a way that actually forces the executive management to enact corporate change?
This is arguably the most crucial phase of the entire internal audit lifecycle. Communication.
How do we avoid the nightmare scenario of the report just sitting in a drawer?
It requires a completely different skill set than investigation. If you cannot communicate the risk in a format that forces a busy board of directors to understand the danger and demand action, the entire months-long audit was effectively a waste of time and money.
Let's look at Q9, the case of Kishore Ltd., to see how this is structured.
Mr. Anand is the chief internal auditor here. The audit committee has called him in. They want a detailed report, but they are very specific. They want to know exactly where immediate action is needed to mitigate critical risks.
They are executives. They don't have time to read a 500-page chronological novel of everything Mr. Anand did for the last 3 months. They want actionable triage.
To deliver that, Mr. Anand must rely heavily on standard on internal audit SIA 370, which governs the reporting of results. First, he needs to understand that there are 2 distinct stages of reporting in his role.
Break down the 2 stages for us.
First, there is the assignment-specific report. This is the tactical document issued right after a specific localized audit is completed, like the DREAMS PVT Ltd gym audit we discussed.
It goes deep into the operational weeds of that specific function.
Right. Second, there is the periodic comprehensive report. This is the strategic document. It is usually prepared quarterly by the chief internal auditor.
And its goal is to synthesize all the individual assignment reports into a massive, high-level overview of the company's entire risk posture for the audit committee.
Exactly. So when the audit committee actually opens one of these reports, what does the architecture look like? How is it designed to grab their attention?
Tell me.
A highly effective SIA 370 compliant report follows a very specific anatomy designed for executive consumption. It starts with the audit scope and period, defining exactly what was looked at and the time frame.
Okay.
Then, crucially, it moves immediately to the executive summary.
Because nobody on a board of directors is going to read page 30 unless page 1 convinces them that the company is on fire.
Exactly. The executive summary is the elevator pitch of the risk. Following that, you have a summary of critical findings. But here is where the real professional value is delivered.
How so?
When detailing the findings, the auditor cannot just write a list of complaints. They must rigorously elaborate on 2 specific analytical components for every single issue: the business impact and the root cause.
Let me make sure I understand the distinction. Business impact is obvious. The empty gem is costing us $50,000 a year in wasted rent, and the idle cash is costing us $100,000 a year in lost interest. You put a dollar figure on the pain.
Yes.
But why is root cause so critical? Isn't the cause just management rented a gym and didn't force people to use it?
No, that is merely the symptom of the disease. The root cause analysis requires the auditor to ask why the symptom was allowed to occur. Why did they rent it, and how is it forgotten?
Oh, I see.
Perhaps the root cause is that there is absolutely no central oversight of real estate leases. Perhaps the HR director who championed the gym initiative left the company 2 years ago, and there is no protocol for reevaluating orphan projects.
If the audit committee only fixes the symptom by canceling the gym lease, the company has saved $50,000.
Exactly. But if they don't fix the root cause, the exact same broken management process will simply make the same expensive mistake next year with a massive corporate cafeteria or an unused software license.
The auditor's job is to cure the underlying disease, not just put a Band-Aid on the symptom. That is a profound distinction. Symptom versus root cause.
And how does Mr. Annan prioritize these diseases for the triage the audit committee demanded? Through a strict, standardized rating system.
Every single issue identified is categorized typically as high, medium, or low risk. Right?
Yes. This rating isn't arbitrary. It is based on a matrix of probability and financial impact that is pre-approved by the audit committee.
So the audit committee can receive a 50-page report, instantly flip to the matrix, look at the 5 issues rated high, and say, okay, we need to summon the CFO and deal with these 5 things before we leave this room today.
It turns an overwhelming wall of noise into a clear, actionable signal. It enables executive governance.
But the internal audit lifecycle does not end the moment the report is handed across the table.
Unfortunately, no.
Right, because human nature dictates that management could just nod, say, thank you for this excellent report, put it in a drawer, and then do absolutely nothing to fix the problems.
Which brings us to the final 2 cases in our stack.
Yes, Q10 with June Ltd. and Mr. Gaurav, and Q13 with Upscale Ltd. and CA Sanjana. Both of these scenarios deal with what happens after the aftermath. I call this phase chasing the ghosts of audits past.
This is perhaps the most frustrating yet vital phase of the job. It is governed by SIA 390, monitoring and reporting of prior audit issues.
Let's look at CA Sanjana at Upscale Ltd. She's the newly appointed chief internal auditor. Her staff brings her a stack of old reports from the previous year. These reports are filled with critical issues where executive management formally agreed to implement a fix, but the status is still marked as open. Management just ignored their promises.
A tale as old as time.
So what is her move? Does she just re-audit the whole thing and write a new report complaining about the old report?
No, she deploys what is arguably the most feared accountability document in corporate governance, the Action Taken Report.
Commonly known as the ATR.
Yes.
The Action Taken Report. It sounds like a legal summons.
In the corporate context, it functions exactly like one. The chief internal auditor is solely responsible for continuously monitoring the closure of prior issues. It is their job to hunt down these old ghosts.
How does the ATR work?
Sanjana compiles the ATR. This document lists the original critical issue, the specific action management agreed to take, the target date they promised to fix it by, and the current verified status. Implemented or not implemented.
And what if a high-risk issue is marked not implemented for 6 months past the deadline?
Then Sanjana must calculate and formally document the residual risk.
Residual risk.
This is the ongoing live danger the company is currently exposed to simply because executive management failed to keep their promise, and she bypasses management and presents this ATR directly to the audit committee.
This completely changes my paradigm of what an auditor is. The internal auditor isn't just a one-time detective who solves the case, hands over the file, and walks away to the next mystery. They are the corporate parole officer.
Corporate parole officer is a very apt and visceral description.
They are standing there with a clipboard, month after month, ensuring that executive management actually serves the sentence and implements the promised fixes.
The ATR process ensures that accountability doesn't just happen theoretically on paper, it is enforced in reality.
If management tries to ignore it, the auditor is legally obligated to keep hauling them back in front of the audit committee and pointing at the residual risk until the problem is solved.
Sanjana has to demand answers from management as to why they missed the deadline. If they accepted the recommendation but only implemented a half measure that didn't cure the root cause, she reports that partial failure.
She relentlessly keeps the pressure on until the residual risk is permanently mitigated.
Relentless is the perfect word.
My mind is thoroughly expanded. We have reached the end of our source material and the end of this specialized masterclass session. Let's do a quick, comprehensive recap to make sure our mental models are fully locked in for our listeners.
Let's run through it.
We started with the gateway. We learned that the board has the power to hire such other professional, like Partik the lawyer, valuing relevant experience over strict accounting titles.
Experience is key.
We mastered the triggers using the tomatoes and lettuce mnemonics. For unlisted public companies, it's Publix put tomatoes, lettuce, and dressing. Paid up at 50, turnover at 200, loan at 100, deposit at 25.
And for private companies,
Privates just get tomatoes and lettuce, turnover and loans. And we learned to beware the, at any point of time, tripwire for loans.
never forget the tripwire.
We understand the necessity of the dual reporting structure. Administrative cover to the CEO, functional allegiance to the audit committee.
The undercover agent.
We map the intelligence cycle of an audit. Kangaroos play games catching rings. Knowledge, planning, gather, checks, reporting.
KPGCR.
We built the tool for prioritizing chaos. Real vampires eat all carrots. Balancing risk, value, effort, appetite, and coverage.
The CR matrix.
We learn the strict boundaries. Auditors cannot fall into the compliance trap and grade their own homework. They cannot touch the ledgers, and external auditors cannot rely on internal optimism for significant judgments, like the going concern status.
The firewalls are real.
We went on the hunt, proving that evaluating the utilization of resources like empty gyms and idle cash is a core mandate. We built the 5-pillar digital fortress around audit trails to ensure unique IDs and immutable logs.
Digital fingerprints.
And finally, we explored the aftermath, the necessity of separating symptoms from root causes, and the relentless deployment of the action-taken report to act as the corporate parole officer.
It is a massive amount of highly complex regulatory architecture, but you have successfully mapped the entire life cycle of an internal auditor.
From legal applicability to the final, relentless follow-up.
When you view it as a cohesive system designed to check human fallibility, it makes perfect sense.
If you are listening to this, I want you to take a moment and reflect on your own workplace or perhaps a massive publicly traded company that sits in your retirement portfolio.
Think about the scale.
Think about all the thousands of moving parts, the competing executive egos, the millions of digital transactions. Somewhere in that building, there is a quiet internal auditor sitting in an office.
Deploying the vegetarian vampire matrix.
Right. They're hunting down wasted resources, they're pushing back against angry managers, and they're keeping the gears of corporate governance from grinding to a halt. They truly are the unsung, essential heroes of the global financial system.
They absolutely are the unsung heroes. But as we close this academic session, if we connect everything we've discussed back to the overarching philosophy of governance, this entire framework raises one final, slightly unsettling question. A paradox inherent in the very material we just mastered.
I'm ready. Lay it on me.
We have spent an hour establishing that the internal auditor's strict legal mandate is to ruthlessly evaluate the efficient utilization of resources, to hunt down waste, to demand accountability, and to ensure everyone in the corporation is doing their job perfectly.
Right.
But if the internal auditor is the ultimate watcher of the corporation, who is auditing the internal audit department itself to ensure they aren't wasting time, misallocating their own budget, or missing critical risks.
Oh, wow.
Quis custodia ipsos custodes, who watches the watchers.
Who watches the watchers? That is a terrifying and brilliant thought to end on. Thank you so much for joining us on this specialized tutoring deep dive. Keep refining those mental models. Keep looking for the empty corporate gyms in your own life, and we'll see you next time.